Hello everyone and welcome to our pre-recorded webinar, Understanding Health Savings Accounts. My name is Nicole Smith and I'm the Benefits Education Specialist here at Flex. I oversee all of our educational efforts for insurance producers, plan administrators, and plan participants. Today we're going to be going over the basics of health savings accounts, including eligibility, contributions and distributions, and HSA interaction with other consumer-driven accounts. I'll also take a few minutes at the end to tell you a little bit about HSAs from Flex. Let's get started. So, what is an HSA? An HSA is an individually owned bank account that allows you to pay for healthcare expenses on a tax-free basis. We like to say that HSAs have a triple tax advantage, meaning that money goes into the account tax-free, comes out tax-free for qualified expenses, and any investment earnings are tax-free as well. One of the biggest advantages of HSAs is that they are portable, and any money in the account belongs to the account holder, no matter who contributes. So, the money belongs to the employees from the minute it hits the account, and they can take it with them if they leave their employer. Even better, unlike FSAs, HSAs have no use it or lose it requirements. So the money in the account can roll over indefinitely, and there are no caps on accumulated balances. Who is eligible to open an HSA? In order to open a health savings account, individuals must be a U.S. taxpayer who is not claimed as a dependent by another person. They must also be enrolled in a qualified high-deductible health plan, but not covered by any other non-qualified plan. A qualified high-deductible health plan, or HDHP, needs to meet deductible and out-of-pocket requirements set by the IRS. These amounts are tied to the level of coverage on the health plan and are periodically indexed for inflation. For 2017, the minimum deductible is $1,300 for individual coverage and $2,600 for family coverage. For 2018, these go up to $1,350 for individual coverage and $2,700 for family coverage. For 2017, the out-of-pocket maximums are $6,550 for individual coverage and $13,100 for family coverage. In 2018, these go up to $6,650 for individual and $13,300 for family. Most importantly, the plan cannot have any benefits that pay out before the deductible has been satisfied. So that means that no copays are allowed for office visits or prescription drugs. The only exception to this is preventive care, which is covered at 100% with no deductible as per ACA regulations. In addition to being covered by a qualified HDHP, eligible individuals cannot be covered by any other non-qualified plan. Some other types of coverage are allowable. These are plans such as dental, vision, disability, long-term care, and critical illness. Non-permissible plans would be HMOs, non-high-deductible PPO plans, Medicare or Medicaid, military coverage such as TRICARE, and the healthcare FSA. Some exceptions do apply to the healthcare FSA, and we'll talk about those in more detail later. Moving on to HSA Contributions. Annual HSA contribution limits are also set by the IRS. These are also indexed for inflation. For 2017, the limit for individual coverage is $3,400, and that is being increased to $3,450 for 2018. The family limit is $6,750 for 2017, and that is going up to $6,900 for 2018. Individuals who are age 55 or older can also make an additional $1,000 catch-up contribution each year. It's important to remember that HSA contribution limits are tied to the level of coverage on the health plan, not to an individual's family makeup. So someone who has a spouse and 10 kids but is enrolled for individual coverage on the health plan would be subject to the individual coverage limit. Now, this doesn't mean that the money in the HSA can't be used to cover expenses for the spouse and children. It just limits the amount they can contribute. Conversely, if they cover at least one other person on the health plan, then they can contribute up to the family maximum, even if other family members have coverage on a non-qualified health plan. HSA contributions are also prorated on a monthly basis, so technically you can only contribute up to 1/12 of the annual maximum for each month you're covered on the HDHP. However, there is a special rule for first-year employees. They would be allowed to contribute the entire amount as long as they are enrolled in the health plan by December 1st. The one caveat here is that they must remain covered by the plan for all of the next year. One of the benefits of the HSA is that anyone can fund it. Contributions can be made by the employee, the employer, family, friends, or any combination of those. The only rule here is that the total annual contributions from all sources cannot exceed the annual maximum. Another big plus is that the HSA funds can be invested. Investment options vary by custodian, but generally these funds can be invested in stocks, bonds, mutual funds, and the like. And don't forget, the investment earnings are tax-free. Money can be put into the HSA through a couple of methods. One of the most popular is through payroll deductions. These deductions are done through the cafeteria plan, and they avoid all payroll taxes. This is a great method not only because it saves the most taxes, but also because it's a consistent method of getting funds into the HSA every pay period. I like to call this the set it and forget it method because employees don't even have to think about it. The money just goes in automatically, and chances are they won't even miss it much. Account holders can also transfer post-tax funds into the account. This is also a good method because it lets the account holder determine the frequency of contributions, and it can also really come in handy for large unexpected expenses when there might not otherwise be enough money in the account. Any post-tax funds transferred into the HSA can be taken as a deduction on the federal income tax return, but this method will not save quite as much in taxes as the payroll deduction method. Of course, you can always use a combination of both methods as long as you don't go over the total annual maximum. HSA contributions can be made up until the tax filing deadline for the previous year, so account holders have until April 15th of 2018 to make HSA contributions for 2017. HSA expenses can also be reimbursed at any time, but you cannot reimburse yourself for an expense that was incurred before the account was opened. Any contributions over the annual maximum will be subject to federal and state income taxes. If the excess contributions are removed prior to the tax filing deadline, then no penalties will apply. However, if the excess contributions are not removed, or they're not removed until after the tax filing deadline, a 6% excise tax will apply. This tax is payable when filing the federal income tax return. Okay, we talked about how the money gets into the account. Now let's talk about how it gets out. Qualified medical expense distributions are defined in IRS Code Section 213D. These are basically anything related to healthcare, and they extend far beyond the health plan. For more information on what's considered a qualified expense, you can refer to IRS Publication 502. Some examples of qualified expenses are things like health plan deductibles and coinsurance, dental expenses, vision expenses, and some other things like diabetic supplies or hearing aids. Remember, as long as the HSA funds are used for qualified expenses, there are no taxes on any distributions. HSA account holders can actually take money out of the account at any time for any reason. But if the distributions are for non-qualified expenses, then income taxes and a 20% penalty apply. Note the penalty is waived for individuals who have reached Medicare age, but income taxes would still apply in this situation. Some examples of non-qualified expenses would be cosmetic procedures, maternity clothes, toiletries, and over-the-counter drugs without a prescription. As we've discussed, HSAs have many positive points, but they don't always play well with other consumer-driven accounts. The HSA regulations are written in such a way that account holders cannot have any other benefits that pay out to them before the health plan deductible has been satisfied, which can make it tricky to pair HSAs with other CDAs. Healthcare FSAs in general are not compatible with health savings accounts, and enrolling in one would eliminate HSA eligibility. Other types of FSAs are allowable though, such as the limited purpose FSA, which only covers dental and vision expenses, post-deductible FSAs, or dependent care FSAs. Remember though, that FSA elections are binding for the entire plan year, so employees enrolled in a healthcare FSA would not be able to open an HSA until after the end of the FSA plan year. That seems simple enough, but it can get a little complicated when grace period and carryover come into play. If the plan has the grace period and funds are carried over, then the employee will be ineligible until the grace period ends. If the plan has carryover and any funds are carried over, then the employee will be ineligible for the entire following plan year. HRAs can also cause problems, as in many cases, participation in an HRA will eliminate HSA eligibility. However, there are some exceptions to this. Post-deductible HRAs can be paired with the HSA without causing any problems. An interesting note here is that the HRA can be designed to begin reimbursing after the employee meets the IRS statutory minimum deductible, which can be less than the actual health plan deductible. The HRA can also be designed to reimburse coinsurance only. Limited purpose HRAs are also permissible. These would be HRAs that only reimburse dental and vision expenses. Okay, now that we've covered all the basics of HSAs, let's take a minute to talk about HSAs from Flex. At Flex, our HSAs have full integration with Healthcare Services Corporation. HCSC is the parent company that owns Blue Cross Blue Shield plans in Illinois, Montana, New Mexico, Oklahoma, and Texas. Here in Illinois, we are listed as Flex HSA Plan on the BPS and within Blue Directions. We also receive both claims and eligibility feeds directly from the BCBS plans, which means that when an employee signs up for the HDHP, Flex will receive the information on the eligibility feed, and we can reach out to the employee to explain how to set up the HSA. Account holders can also choose to have their Blue Cross medical claims automatically reimbursed from their HSA. Our HSA includes free integrated debit cards that are stackable with other benefits like the limited purpose FSA. We offer online investment services and contribution management. We also provide an easy-to-use website and mobile application, and both pre- and post-enrollment support and communications. Most importantly, you'll have full access to and support from our experienced staff. If you'd like to learn more about our HSA or consumer-driven accounts in general, you can visit us online at www.flexiblebenefit.com or give us a call at 866-472-5351. You can also contact us at marketing@flexiblebenefit.com. I want to thank you for watching today, and I hope you found this presentation helpful. Please feel free to contact us with questions or if you need more information. Thank you very much and have a great day.